All right, ladies and gentlemen, hello, welcome. You're watching Bloomberg TV India, and this is the Alternative Investment Summit 2013. The topic of our discussion today is talking about various alternative investment assets and the outlook going forward from there. We've got an esteemed panel joining us right here. Let's really start off by understanding as to how important or what the traditional investor really looks like. Someone come in on this. Let's try and understand when we talk about investment in India. Traditionally, what has it all been about?
Traditionally, investments in India have always focused on traditional investments like equities, like fixed income, fixed deposits. Of course, you have real estate, which is a very big play. But I think what happens when traditional investments don't do very well, Priyank, when you have difficulties in returns on the traditional investment side, which is typically what we've seen over the last maybe 4 to 5 years, there is this interest which then emanates in the alternative investment space. And that's something that the fact that we have a conference like this today really does reflect a bit of that as well. Given the environment and given the fact that we have a situation where we've got, in some ways, a bad economic environment, it's not necessarily a bad investing environment in the area of alternatives. So perhaps when you start looking at companies, we have a situation, a classic situation where debt is theoretically quite expensive. You have very low capital market activity. You've got promoters who've actually invested a couple of years ago and the capacity utilization is now almost fully utilized, and they do need more capital to expand. So where do they go? And that's where, I think areas like private equity funds, VC funds come in very nicely to be able to provide the necessary capital for companies at this stage. So a bad economic environment, but perhaps a great time to actually invest.
It's a valid point. In fact, let's try and break this up into what we've seen traditionally. Now, Anuj, one of the clear factors here in terms of investment, what we've seen historically in India has been real estate. I mean, that's one of the most attractive, one of the most no-brainer investment that they've been doing. Give us a sense to what lures investors towards the real estate segment.
Well, if you were to ask me today, I think nothing lures them to real estate investment. I think it's a bad sector, it's an untouchable sector, it's a sector which the media loves to bash. So clearly, I'm not sure why I'm on this panel, but it is a sector which is pretty much disliked. It's got liquidity problems. There's a huge amount of leverage that the developer community has. There is an oversupply situation that has been built up in various asset classes, whether you were to look at office, retail, residential. The consumer or the investor continues to believe that the residential prices will come down from where it is, and hence is not really investing because he or she believes that the prices will come down, and it lacks transparency, lacks governance. I think in many of the Indian Bollywood films, you will see the villain is the developer, the real estate builder in there. That is what I think the sector holds. But I think on the other side, if you were to look at it consistently over decades, it has performed very well. So if you're a patient investor, if you understand what real estate is, it has outperformed even the stock market, even the equities in that perspective. I completely agree with the opening comments that Soumya made is that when the times are bad, that's the time when an investor should really look at it. And I think is real estate, if you were to ask me today, many of the asset classes and many of the opportunities that are available are below the replacement price even. That is the kind of haircut that you're going to be, opportunities that are coming up available today is that below the replacement cost. So, which means that if you want to buy an office, within the area where we're sitting in Lower Parel, you will get office today below replacement cost. So if somebody was to buy land, build the office, pay the interest cost on the funding, you will see is that the finished cost of that office is lower than what you're actually going to make it up. So it's a great opportunity, but you need to really understand and be a patient long-term investor in real estate. One other point that I'll say is, I think the funds haven't made money in real estate, and also the investors who have put money on equity in the listed entities of developers haven't made money on real estate. But I think there are reasons why they haven't made. I think the foreign funds which made money also in real estate did not make money because of the devaluation of Indian rupee in there. I think some of the smart Indian investors made on a project level, but I think at the fund level, people haven't been able to demonstrate that they've been able to make money. And on the listed space, clearly if you were to look at it where they were listed at, I think most of the stocks are 80-85% below from the price where they had listed. So I think that's why the charisma has moved away from investing into real estate. But I genuinely believe is that when it moves away from investing into a asset class or a sector, that's the time that you should really look at investing.
Fair. I'm going to come back and discuss that in detail in just a couple of minutes. But Mahesh, come in on this. We've got the opening comments out here. We've tried to understand as to what the psyche of the traditional investor is, what he's been looking at. We've got some perspective from real estate as well. But private equity, now that's really been the key thing. The entire PE industry, the way it's evolved. Give us as to how it's actually moved in the last couple of years. And as Soumya was saying, one of the key reasons is with that whole recession coming in, with the slowdown, people started to look at other avenues of investment.
I remember once, I think I come from a lower middle class Tamilian Brahmin Iyer family. You can't get more traditional than that. My dad read my name in the paper saying that I'd invested somebody, called up and said, why are you doing that? Give it to me. I'll put it in an FD. And that would have been wise advice actually, given that I was investing in 99, 2000. But we've come a long way since then. I think today at least we've gone through 2 cycles in the last 14 years. We've also been fortunate as a fund, at Seed Fund, our first fund, we actually returned 3x money, and our LPs told us, look, nobody else in India has ever given back any money, let alone 3x, and we still have more to return. Yeah? And we've been fortunate in that we've had several blockbuster exits above 10 or even 20x. I think what's really interesting out here is where we saw the opportunity was to say that, look, consumption is growing in India, consumer needs are growing, brands will need to be created, lots of white spaces exist. Is there an opportunity to create great businesses out here? In some ways we went against conventional wisdom. Conventional wisdom says that, look, there's Brazil, Russia, India, China. So if Yandex is the Russian Google, then Baidu is the Chinese Google. We need to have an Indian Google. We need to have an Indian Facebook. We need to have an Indian Twitter. But our sense right from the beginning is that the Indian Google is Google and the Indian Facebook is Facebook and the Indian Twitter is Twitter. We are not really, this brick thing is nonsense actually when it comes to investing at our level. But what we can do is create great companies from the ground up that solve an Indian problem, that can really become large, big consumer brands, and more importantly, do that without spending a lot of money on advertising. So we built Redbus into an 800 crore revenue company. You never saw an ad for it. We built Carvale into absolutely 80% market leadership in the car space, but you never see an advertising. So we've been able to do that because of the rise of digital media. And now today we own, for example, India's largest dental chain. We own India's largest rural hospital chain. So we're not just focused on digital products, but products that can grow by digital word of mouth or by word of mouth. We think there are many white spaces. It's taken us, however, 14 years to convince investors to do that. And once we understand the investor psyche, somebody in the US has broken the world into first world, second world, third world, real estate, hedge fund, private equity. Early stage VC is the most risky part of the emerging world. So we are actually in the least favored kind of, 1/9 of the market. But the nice thing is the expectations there of return are interesting. So once you're able to give 15, 20, 25% IRR, their eyes perk up. Because frankly, even though you might say PE is this whole big thing, the only part of PE that actually has performed in the last 5-7 years in India has been early stage. Growth hasn't performed, PE hasn't performed, maybe some pipes and large scale hedge funds have grown. But really, and that's really gratifying, and I think even in the next 5 years, you'll see the same thing. The small companies which can go up that path, which don't need to sit and copy paste, don't try to build the Amazon of India by putting 3,500 crores in the bank, those are not going to do well. You start something small and build it large without really spending on advertising, you can do really well.
That's a fair point that you've actually mentioned on the entire industry and the way it's actually shaped up. I'm going to come back and discuss a little bit more in terms of the potential there, but Soumya, let's talk about how the landscape's actually changed out here, because we've been talking about the real estate sector, we've been talking about the private equity. Clearly, there are options that are popping up now for investors to actually look at beyond the traditional part itself. How is the landscape now changing for investors?
I think we've seen it evolving quite steadily with the fact that you have obviously a real estate play, private equity play, VC play, which is coming, which has been there. I think what we've seen is, and certainly from as an advisory company working with family-owned businesses, we've seen it evolve at least over the last maybe 5 years, from your very real estate centric kind of products like NCDs and real estate funds, to the fact that family owned businesses and family offices are looking at VC and angel investing very seriously, because they themselves have been entrepreneurs, they've been successful entrepreneurs, and they in some ways feel that they can actually give back to their to related industry and mentor other new entrepreneurs. So you do see a lot of that come into play. What Waterfield is also concentrating on now as a firm is that as we get more and more deeply entrenched with family-owned businesses, we actually find that we can start working with the private equity players, because at the end of the day in today's industry, only 1/6 of investments have actually been exited. So there is 5/6 of companies which private equity players have invested into. Their fund life cycles are coming to an end, but those investee companies could be extremely interesting for family-owned businesses in terms of strategic investments. So we actually see that as an area which is playing out, which could be of interest both to the PE firms which are looking for the exits and for the family-owned businesses that are actually looking at diversifying into related and ancillary businesses. So certainly we see from the real estate NCD fund structure to how do you look at unlisted investments and into certain spaces as well, related to what families are looking for.
Since you mentioned about the PE part itself, is co-invest something that you're working with very closely? Is that a potential game changer as well?
It is specifically in the area where it's a fund structure, because what we have found is that for a lot of families, what are the big risks and alternatives at the end of the day? Good due diligence and a thorough due diligence, and the other areas in terms of exit. These are the two big things that any investor is actually looking at. The moment you have a situation where you are coming in as a co-investor, you do feel a great deal of comfort knowing that there is a good institution which has done a very thorough, comprehensive due diligence, and the fact that there is an entity that's looking at an exit. So when you come in as a big family office to make a co-investment, then you feel that, okay, there is somebody else who's got skin in the game to a certain extent, and therefore you're much more confident about putting your capital in at that stage, rather than going completely by fundamentals in a company, which again a lot of families do look at. But I certainly think that co-investment's a great way for family offices and larger, more sophisticated investors to actually take a play in this area.
So if I can add something to what Samir was saying, I think the big difference you're seeing between the world of investments my dad grew up in and the world of investments options that we're growing up in is many of those investments were kind of fill it, shut it, forget it. You put it away and then you can't do anything. I mean, what can a person do to increase the value of real estate that you bought? Not very much, right? What can you do to increase the value of a fixed deposit? Not very much. But the interesting thing out here is where it becomes strategic, where you have, for example, one of India's biggest IT tycoons is an investor in my fund. So we have the ability of taking our company to him, getting that level of advice from somebody who runs one of the world's largest companies to be able to take that company forward. So that ability for that investor to come in and say, okay, look, I understand this and maybe I can help, is not just positive for the company, but it's also thrilling for the investor, because they know that they're actually part of it, and it's not something that somebody told them put money there and walk away.
That's a fair point, and the fact that private equity itself has evolved so much, there are newer products, newer strategies that coming in. But let's also highlight about the real estate space, Anuj, out here, because since we're talking about the private equity space, what about the real estate sector? Are we expecting newer products that can actually lead to some kind of investor interest as well? I mean, barring the fact that from the traditional way of looking at it, is there a potential there could be some newer products that investors can probably look at when we talk about the real estate segment?
Absolutely. I think we've evolved over a period of time. So 2006 is the first time when private equity as FDI was allowed to come into this sector, and since then we've made a fair amount of progress. We've had NBFCs giving money to the real estate sector. We've the NCD structure, which is a very mature instrument to come in there. We are hoping that over the next few quarters we will have the REITs come in, and I think that it'll be a phenomenal change that will bring to the real estate sector. It will be treated more like an industry. Today it is not being treated as an industry. I think it will institutionalize the sector itself, and I think it will benefit all the stakeholders. The investor today, if you were to look at the small retail investor, they don't have an ability to play in the real estate market. Somebody's got 50,000 rupees. How does he play in the real estate market? The only way that he or she can play is by investing into the listed stocks of the developers who've gone public. Other than that, you can't play really with 50,000 rupees. So that will, through the REITs, they will have the benefit to be able to, ride the wave on the real estate. But more importantly is going to be really for the nation as such. Because today, what we see, the products, particularly office and retail, are fully built, leased out, and these assets are leased out.
Sure.
And then they are parceled as small units and sold, because that's the only way that the developer is going to be able to exit that asset. Now, what happens is 10, 15, 20 years later, nobody wants to care for that asset. Look at what's happened with Nariman Point. All the buildings that are there are because they all strata title sold. With the REITs coming in, they're going to buy the full building. And their ability to then manage, maintain, enhance the value is only going to improve the value of the building. And nationally, we will have a real asset that will start to get produced on a long-term basis. And the developers, who are today building up buildings thinking that I'm only going to sell it off as a strata title, will really do a great job, because the thought would be, I'm going to do a REIT, I'm going to put this building in the REIT, this is a long-term asset for me. So I think that is the evolution that we are really waiting for. I know that it's unlikely that this government is going to be able to do the REIT, because it necessarily needs to go through the budget session for the taxation, and we've got a vote on account, so it's not going to happen. But I'm hoping that when the new government comes in play and in their first budget, this is a priority that they are able to bring it in. One other thing is that if we do bring in REIT, you will see a fair amount of institutional investment coming in from overseas into this product. Who's not made money is the private equity, which went into early stage development. And I think we all got it wrong at that stage. About 100 acres of land parcels, perhaps wrong partners, the approval process one was not able to understand, the usage one was not able to understand, and they've not been able to exit. We did this survey, and it is a very interesting survey. What it said was that if you invested $1 in 2006, the value of that in real estate, if it was an office, you made 1.2. So which was great. If you did it on retail, you made 0.8. So you actually lost 20 cents on a dollar. If you put in an equity, you lost 80 cents, so it was only 0.2. If it was mixed development, it was 0.7. If it was hotels, it was 0.65. But if you had bought land and did nothing, and you went on holidays after that, you made 5x. So really, those people who didn't work and enjoyed are the ones who made majority of the monies, because they just bought land, sat on it, the land value just kept on and on and on, and then in the end have just flicked the land and made 5x of that, which is interesting. So the only guys who made money are really those, but anybody who's done development hasn't really made that kind of money. So we feel is that the next form of investment that is going to come in, which is what Blackstone is doing very clearly, is buying income yielding assets. They're saying we don't want any risk of development, we don't want any risk of partner, we don't want any risk of approval. We're going to buy a completed office building fully let out, and we will pay you 10, 11%, whatever the yield is on that, capitalize it, and we're going to buy it as 100% or 50% with a well-known partner, and that is what the investment today is going in.
Yeah, that's an interesting product you mentioned there. Mahesh, I want to come on, since we're talking about some of the unique products that are now coming into the market, what about crowdfunding? How do you see that potential coming in? Is that something that a larger audience can look at? Because we've seen the success clearly in a couple of these countries, maybe US, in Europe for that matter, and yes, it's picking up slowly in our country as well. But what is the potential that we can actually see from there?
So I think it's not yet come to a large scope, as large a scale as it's come to in the US. In the US, it grew for 2-3 years with Kickstarter and other places, and now there's an act, the Jobs Act actually officially supports crowdfunding. You can, in the US earlier, you're not allowed to crowdfund a company, you could crowdfund a project.
True.
But now you can actually crowdfund a company. So if you go on Angel List, and I'm an investor there, so I put money in a few crowdfunded US companies out there. We don't yet have regulatory clearance out here to crowdfund companies, but we certainly have crowdfunded projects. A good example of this is 2 or 3 movies which have been crowdfunded reasonably well. It'll grow. I mean, I think you'd find that the market for this is not so much the wealth advisors, because, the typical bite size per investment may be, 10, 20, 30,000 rupees at the most, maybe 500 rupees at the least, right? These are really far more consumer, middle class friendly products. If you want, I mean, if I'm somebody and, all I have to invest in a month is 10,000 rupees, I'll maybe put 8,000 rupees in a SIP. with $2,000, I'll say, let me just take a gamble on some crowdfunded thing. I'll get something out of it. I don't expect to make 2 million from 2,000, but I'll make something. So it's much more of a retail product. It's really not a product for people who manage a significant sum of money, because you can't. I mean, if you go and put a lot of money into a crowdfunded project, you'll kill it.
True.
So it has to really have a wide base of investors putting small sums of money each for it to really work well. So it's not really something that we look at too seriously. We think there will be companies that can be crowdfunded that can then come to us. Our typical investment by it is 2 crores to 30 crores.
Okay.
Right? So we can't ourselves crowdfund. So, but if somebody comes and is angeled by a crowdfund, we're happy to look at it and then go further. So the nice thing, the equivalent of this is the rise of angel funding in India. We had almost nothing 10 years ago. So today, Mumbai Angels alone is about 300 people. Indian Angel Network, so we have about 1,000 angel investors in India. And they've probably put in together about 500 crores into this already. And some of them have done well. And that's good. So the investing ecosystem is being built out. If we are early stage fund at the bottom, below us are the angels and the crowdfunders. And that's really being scoped out. So it's good. So that this ecosystem is forming, the pyramid is forming.
Fair enough. Now, Samit, the big question out here is, from an investor standpoint, what about returns? Because you may have 20 options in front of you, but how do you get those returns in? Which is the best way to look at it? So my question to you here is this. On one side, you've got those traditional products, maybe the equity, maybe your debt, or even for that matter, the FD. How does one look or justify or look at investing in some of these alternative assets or alternative investment avenues? How do you justify a decision to actually go ahead and put the money in somewhat of an off product like that?
I think the first thing that you actually need to look at is fundamentally, like all good financial planners, you do need to look at asset allocation. You do need to look at how much are you going to really put aside towards alternatives in the first instance. And that means that you must very clearly understand what is your risk profile, what are your investment objectives, and then determine necessarily what is the asset class that you're going to invest into. I think also what happens in the alternative space, which is very different from traditional investments, is that in traditional investments you will always look at relative return, and the investment framework is around relative return, whereas in the case of alternatives it's always about absolute return and absolute targets and objectives. So that's a very different mindset when you're actually investing. So in that sense, I would say that, people have to get comfortable with that. People have to get comfortable with the fact that, it's not relative to somebody else in terms of a style box or in terms of long only. It's more about, what is the absolute return that I'm getting on a particular investment. And certainly you must have a pretty long horizon. Let's be very clear, alternatives are illiquid in nature. So that means that the investment cycle is typically something which is 5, 7, 10 years. And investors need to be comfortable with that. So that's in
so
terms
of
of
something out there. When we present to our LPs and our investors, we understand that they have a portfolio to manage, and our own positioning always is that, so what role does early stage venture or early stage PE play in that portfolio? And we kind of think we're like the spice in the curry. So you can have the dal and you can have the bhat, but finally for it, you can get a 3%, 5%, 7% IRR. A lot of people, overseas funds are very happy with 5, 7% IRR. Apparently, many others have not even kind of delivered that, because you have a 100% chance of getting a 5% IRR. What we probably represent is that 25% chance of getting a 25% IRR, right? So somewhere out there we say, look, if you need to have that spice in your portfolio, you must look at these classes, which are by nature risky, inherently risky. They're riskier, and hence they're potentially more rewarding. As long as you figure out, okay, fine, there's reasonable risk assuage mechanisms. And that's where India wins out, compared to Silicon Valley, where you can put $10 million in a company and it can fall apart. Here, as long as you figure out, look, you have a process in place where if something's going to die, it dies quickly and cheaply. And you only put more money. So even if you decide to give somebody 30 crores, you don't never write a 30 crore check. You start with a 3 crore check and say, let's see how it goes. Let's tranche it, right? So if something dies, let it die quickly. If something survives, then drip feed it over time. If you do that, then you can actually figure out that you can significantly increase your IRR with that money, and you can be that spice in the dal bhat.
I'd probably like to add a point there as well to what Mahesh said. You've obviously got, since May last year, 77 new AIFs which have come in. The way that a lot of investors are looking at it in terms of the entire segment right now is really they're putting in trial amounts of money into some of these products and these funds. So Will we see a lot more capital in these areas in the next 6 months to a year? Definitely. I think for a lot of investors, it's really about testing the waters right now. As you rightly said, you know, if it's not working, then it dies very quickly and cheaply. So for a lot of investors, they're looking at, okay, I'm going to invest a small amount today, see what it looks like 1 quarter, 2 quarters, 3 quarters out, and then really commit to more money in some of these areas going forward.
So the one thing out there is, actually, the early stage funds aren't big. You know, my first fund was 65 crores, my second fund was 300 crores. It's a drop in the ocean compared to most other funds. But the more interesting thing about, other than the spice in the curry thing, is really that you actually get a view. So the first fund in the world that Google invested in was us, right, from the US. And their point was, we're doing this not so much to make money. After all, you know, what can a small fund do?
Sure.
Difference can it make to the balance sheet? But their point was, this is an early warning signal for us. You guys are sensors for us to figure out what's happening in India. Ditto Motorola came in on that. So I think if you're coming from an investing point of view, saying, okay, this is not just a reasonable chance to make money, but I have my eyes and ears on the ground, and there's a bunch of these new guys, this new economy. I want to figure out what's happening. I want my eyes and ears on the ground there, because it may or may not help my core business. Now, I may be in a manufacturing business, I may be in a plastics business, I may be in something else. So there's also a strategic value to having having your small kind of skin in the game in 15, 20, 30 companies, which might actually end up changing the world.
True. In fact, what Mahesh and Soumya have actually highlighted out here is the capital bit, and I want to pull that a little further in terms of the way the capital and how important is it. Now, let's talk about the PE sector out here. Do you see that trend changing? Because the myth always is you need deep pockets if you want to get involved as far as PE is concerned. I'm talking from an investor standpoint itself. You think that's changing?
Actually, you know, one of the really interesting things is I started investing in India in 1999. It takes much less money today to start a company in India than it did 14 years ago. 14 years ago, if you wanted to build a website, you needed a content management system. It was $250,000. Today, it's $2 a month, right? 14 years ago, if you wanted to buy a broadcast quality camera to create video content, it was 3 lakhs. Today, your phone can do it for 3,000 rupees. So there's an extraordinarily, there's been a huge decrease in the cost of, there's been an increase in technology with Moore's law and whatever else, and a decrease in the cost of producing a website. You can start a business for very little, everything. You can rent space on Amazon, $5 a month. Buy a domain name, $10 a year. So once you do all that, you can kind of actually figure out now, with very little money, you can start a business. Now that's a good thing. That's also a bad thing, because everybody starts a business, and it becomes harder to figure out who do you fund, who do you back, which of this can be really exitable. Because actually, in one way, and give me a minute, the market has really changed really in one way compared to 15 years ago when we started. If you look at most sectors, let's say pharma, let's say automotive ancillaries, you take any sector, the biggest company would have like 18, 20% market share. The next one would have 16% market share. Then have 14% market share, then 10% market share. So you could invest in a sector all the way down to the top 10 companies or top 20th company, and you'd be okay. If you take the new age companies, all the companies that have grown up in the last 5 years, it's something very different. There's Google in search, there's no number 2. There's Facebook in social networking, there's no number 2. There's eBay in auctions, there's no number 2. Right? There's Twitter in microblogging, there's no number 2. There's Amazon in broad global e-commerce, there's no number 2. Essentially, it's become a winner-take-all game where instead of 20, 18, 16, 14, you have 85, 8.5, and 0.85. Right? So the nature of business change has become a winner-take-all business. True. We know, we back Redbus, 85% market share, Carvale, 82% market share. Right? So we know that if you back a winner, we can go all the way. But if you back the number 3 company, you're a nobody. So it's become riskier from that point of view of finding an exit, because the new nature of business is really something that coagulates, that gathers towards the one dominant winner. So for us, it's even harder saying, A, it's cheaper to create the dominant winner, but True. 2, you have to really find a sector and create it. So you can't do too much back analysis, you can't do too much curve fitting on an Excel spreadsheet, and you can't do regression analysis, because you're sitting back and saying, what does my gut say? Can this become a sector? Can this guy run the sector and own the sector? So it's really, what can I say, the stakes have become higher, the cost has become lower, mortality rate has become higher. It's really changed business. It's a lot more fun. I've learned so much in the last 15 years in India. But it's a great time to be here. I'm actually buying for the next 6 months. He talked about, we're all waiting for the government to change. I'm saying this is the best time to buy, because I do believe that, exits will happen then, the prices will go up then. So for us, this is happy hunting grounds right now.
But you think there will be products in the future, or at least in the near term, where investors with a small ticket size can get exposure to the private equity
Absolutely.
space?
If you join an angel fund, or even, so maybe for us, we've got people who've invested 3, 4, 5 crores at a go. But at an angel fund, you can put 5 lakhs at a go. It's fine.
In fairness, many young companies, when they start, they first go to friends and family.
True.
So if you actually look at it that way, there are friends and family who are taking, literally VC bets on companies that, their friends or family have started. So to that extent, I think it is very much there already, indirectly, unorganized,
True.
rather than a more organized manner.
What about real estate? The same context. And capital always a big question when we talk about real estate sector. You think that's changing from here? Will you see a bigger participation coming in from investors? But again, from the ticket size point of view, not necessarily being so large as to what we've seen probably in the metros right now, but at a smaller ticket size. And as you mentioned, will REITs probably be the game changer?
So I was just thinking, when Mahesh said is that, he is the spice in the curry, I said, we guys are like hot chili, gunpowder real estate. Once you taste it, either you like it or you run 100 miles away from that. That is what real estate is. Equally, Soumya said is that you can do 50 lakhs, 1 crore. I think real estate is a big game. It's one, it's a big game. Second, Mahesh, it's a patient game. So, I cannot today act thinking that I'm going to sell when the government comes into power, because it's a highly illiquid, unlike some of the assets that you are able to do that. So very, very sort of capital intensive, and then you have to be really patient. I certainly think there is a huge amount of appetite for leased income. We were selling an asset in Gurgaon, 2,400 crores. The value of that asset is. We had 5 bids at 2,400 crores. Can you imagine at this market? So we're nearly 12,500 crores chasing that one asset. So that's the kind of money that is willing to come into India. But what that money is looking at is a stable return, largely a risk-free return, and they're looking that the surety of that is going to is there. So that is where you're going to find a lot of the big money. So there are several of these big names, whether it's the GIC or Blackstone or CPPIB, which is the Canadian Pension Fund. Each one is earmarking several hundreds of millions of dollars to invest in Indian but stabilized real estate return. And the reason for that is that in India, you're going to be able to get 10-11% return. In more mature markets, you're looking at 6 to 7% return. So look at the arbitrage. Now, once this gets REITed out, the expectation is that it'll be somewhere at 8%.
True.
So look at the capital appreciation that you're going to make the moment you're able to REIT it out from a 10.5% cap that you bought it to 8%. You're like 25-30% on the capital appreciation, and in the meantime, you're actually making income every month because there are rentals coming in. I think the only flaw in this is that we're banking a lot on the REIT. Otherwise, what is the exit? I don't know. There is no light at the end of the tunnel. So there is a huge amount of investment that is going to buy income yielding assets.
Sure.
But with the hope that there is going to be light at the end of the tunnel. But if you were to ask today in the legislation, there is no light at the end of the tunnel. It is a hope that this will come in and that people will be able to exit.
Fair enough. That's a view coming in on real estate there. So let's try and really summarize as to what we've been discussing. Soumya, we've been looking at various options out there, both on the private equity and the real estate side itself. What is finally needed to get investors interested in these products and probably products that are coming up in the future?
I think really awareness. As people also start appreciating and understanding the kind of returns that they get and have good experiences in the area, I think you will see more investor interest automatically. At the end of the day, let's be quite clear, people look at return, in terms of what they're getting on their investment, and they're extremely sensitive to that, extremely sensitive to the capital being preserved. So one is just changing the mindset of investors that when you're coming into this asset class, you have to really look at it quite differently in terms of risk profile, risk factors, and your investment objective. So I think it's a question of awareness. Again, conferences like this just enable us to just talk through the issues. And I think once you get more awareness and investors start getting clear exit options in their investments, then they'll be far more open to actually looking at this sector as a asset class far more favorably than perhaps what has been there in the past. And certainly if regulation can support it, then I think we're really making steps in the right direction.
So Mahesh, we're just a couple of days away from the new year out here. What's the advice to investors who are looking at the alternative investment side? What would your advice be to them?
So actually, it's going to sound very disappointing. If you'd ask me, I'd say, buy the big stocks in the market, right? Buy the long Nifty calls at 7,000 or whatever, because if you really want to make money in the next 6 to 10 months, that's what you need to do. But if you're sitting here and saying, no, I've got a 10-year timeline,
Okay.
I've got a 15-year timeline, I'd say, well, then figure out how to, rejig your asset allocation. I mean, even if you ask me, one of the issues like Anuj had was the fact that exits are not the easiest things in the world. So we do believe, however, that the smaller exchanges, BSE, SME, NSE, Emerge and others will
Sure.
pop up. They're currently between them doing, 30, 40, 50 companies. Once they get to about 100 company mark, and once they're able to get analyst coverage, we can get a lot more out. So we will see more exits coming. But in the longer term, rejig your asset allocation and say, okay, fine, there's this stuff I give to real estate, there's that stuff I give to fixed deposit, there's that stuff I give to government paper, and there's this stuff that I'm going to have do something interesting and different with. Either it can be strategic, saying, look, I'm a large IT services company, I want to invest in product companies, or I'm a large hospitality company, I want to diversify into a different sector. Or it can simply be that, okay, I'm going to invest with a bunch of guys, and I've vetted out management teams, the kind of work that Soumya does, and these are the kinds of guys that I'd like to invest with because I like their investing theory.
True.
When that happens, you must understand, even historically in the last 40, 50 years, if you look at the data, ever since venture capital started in the US, it has been the best performing asset class in the US ever in the last 40 years compared to all other asset classes. But it's only good, extraordinarily well performing if you pick the right team. It's not like if you invest in 50 funds at one, it's going to work that way. So you've got to be careful about who you invest in, much like you're careful in who you invest in as an entrepreneur. So that's what I'd say. I think open up to the idea. Even for us as fund managers, for the last 15 years, our dependence has been on overseas capital.
Sure.
Now, frankly, we had a problem. Our first fund was raised in 2006. We went to raise the second one in 2008, 2009. Goldman Sachs had happened. The world had fallen to hell in a handbasket. Nobody wanted to look at India, right? So we also understand that we can't simply depend on somebody in another geography because another Greece might happen anytime. Another, Lehman Brothers can happen anytime. We are somewhat insulated from that. So we have to look at Indian investors too. So I think we're a Indian fund, we have overseas money and Indian money. But over time, I think we will have more and more Indian money coming to the fund, enjoying the same benefits that the overseas money does.
Fair. Anuj, any closing comments in terms of what the outlook looks like or what investors need to watch out for when we talk about the real estate segment?
I think it is a good time to invest, particularly on the residential.
Okay.
I think it is great. It is a good time to invest on the office, but office you have to be a lot more educated as an investor because you can't just go in and buy an empty office building.
True.
That may never get leased out. So it's actually a liability that you are taking on with the common area maintenance charge. So you have to be very astute to do that, or buy already leased out building at the current prices.
True.
I would say is don't touch retail as an investment because retail malls are like hotels.
Sure.
So if you're buying, then buy the full mall. Don't buy a small shop in a mall. That doesn't really work. As a class of investment, I am pretty bullish. Just Mahesh said is that perhaps now is the time to really look at what it is. I think in March 2009, just before the elections, we were about this time in real estate the way that it is today. Immediately after the election results came in, strong, stable, government came into, the prices started to go up very quickly. Within 1 quarter, it had started to reach back to the peak. So my guess is that you've got, say, another 2 quarters to really take the advantage.
Fair.
Hopefully, there should be a strong, stable government coming in. Otherwise, I think we're done for a long period of time. But once that comes in, my guess is that you're going to see sentiment-driven inertia, picking up the real estate prices.
All right, fair enough. So that's the discussion coming in across various alternative investment assets that one can actually look at. Let's throw open the forum right now and get some questions going from the audience as well that's been listening in over the last couple of minutes. Go ahead. All right, can we have a mic?
A question for Mahesh. In case of, say, an angel investment, when a client invests, like in private equity, generally when they invest, it's spread over 10 investments. In case of angel, how does it work? Does it work on a specific company basis or?
Yeah. Most angel investments in India today are on a company-by-company basis. You meet the promoters. In fact, if the Mumbai Angels meets very close by to here, I'm happy to introduce you if you email me. What simply happens is the companies present once a week or twice a month, and you figure out the group shortlists 3-4 companies, and then people show their interest by saying, I'm interested, I'm in for 5 lakhs, I'm in for 10 lakhs, I'm in for 20 lakhs. You meet the promoters, term sheets are drawn up, you directly put money in the company. That's the way it works. Though I do hear that they're setting up their own first small angel fund to do that. If you want to invest at a fund level, then you'd invest with somebody like us or one of my contemporaries, where you actually put money in as an investor, we get a management fee, we get a share of carry, and so on and so forth.
In terms of investor acceptance, so somewhere where you speak with family offices or other investors, do they show a preference within alternate asset classes if you were to take the category? So category 2 is where you have a lot of sort of collateral-based kind of alternate assets that you can get into, real estate and those kind of things. Versus, say, category 1 where you have VC funds where you are making investment into unknown, untried companies, and category 3 which are around trading strategies. Is there a preference within family offices more towards one category versus the other? And Mahesh, an extension to the question would be, was it difficult for you to sell the idea of venture investment to the Indian market, particularly considering that Indian promoter class has not really been the most scrupulous of promoter classes when it comes to either IPO money or the private equity money?
In terms of your question, I think what we do see from family offices is a much larger interest in the category 3 at this moment, more on the trading strategies. And if they are looking at making investments specifically for, let's say, social impact or VCs or angel, they will normally do that directly into the company itself. So certainly we do see the interest in Cat 3, and for a lot of them it's about, as I said, trial money that they've kind of put in to various funds to see how they actually perform over the next couple of quarters, and then commit to more capital thereafter.
So if I can add, to answer the second part of your question, I came back, I figured that it took 20, 30 years to build out the US early stage venture ecosystem. We're barely 5-10 years into it. It's going to take, we have to create our own reputation. When we sit with investors, we tell them, look, we have 3 different governments that are invested in us, the British government, the Danish government, the Norwegian government. So we have to pretty much sign up to some of the world's most stringent governance procedures. And not just one procedure, but we have to, what we sign up for is the sigma of everybody's procedures put together. So to the point where I can tell you, out of 33 companies with one company, we found a promoter doing malfeasance, we actually shut the company down. We went back and told our investors we're doing that. With another one, we basically asked the promoter to go. Even though it put a lot more pressure on us because we have to figure out a way to manage the company. So our internal policy is very much a zero tolerance to nonsense policy, right? We know we have to make a name for it, not just that we are liable to our investors who have our heads on the block. We've signed up for absolutely the most crazy governance structures in the world. To the point there's things that we cannot invest in, the things that we have to report forth with any of our companies. So I think that gives some comfort, if not a lot, and plus we have a reasonable track record. I mean, we have probably, 25+% IRR over a period of time, over bad markets, and it's a good thing for people to say. Finally, at the end, we're not asking for 100% of somebody's money. We say, off the money you put, keep aside a little chunk for people like us, and maybe look at it. It might be of use to you. And finally, I mean, some people agree, that's fine. Some people don't, that's also fine. It's a period of time. Some investor, I mean, every investor deserves every fund deserves its LP, and every LP deserves its fund. You figure out what kind of investors and investees work together, and it's right for some, it's not right for some.
In fact, let me also ask Anuj the same thing, because that's an excellent question he's actually asked in terms of selling these products to investors. You think some of the creative products for real estate also would face that kind of a difficulty?
I think the word creative is probably not suited to real estate. I think the difference between what Mahesh said and what real estate is, I think they're very different asset classes.
True, no doubt.
So, the expectation on the governance or transparency is very different. I'm not saying that there isn't. These are US firms, they're listed on the New York Stock Exchange, so they are equally governed by the same, laws and regulations. But they're perhaps not as stringent in terms of that you would take out the promoter and take the asset and start to, develop it on your own. It's going to be very difficult to be able to do that. And I think that's the reason where we're finding trouble in raising foreign capital. to come into the real estate sector because of its just lack of transparency. Just to let you know is that we were moving up very well on transparency since 2002. Every 2 years we'd been moving up on the transparency, except from 2010 to 2012 we've actually moved backwards.
Does that coincide with when Robert Vadra was active in the real estate sector? With DLF or whoever?
So that is where the trouble is, and the institutional funds do not like that transparency is moving backwards, and that's where they get hesitant of entering into a market, or that's where the expectation on the return then starts to go up a lot. A lot of developers ask us is that these funds, which are the same funds, when they're investing in Australia or Europe or the US, the expectation is not 20% plus IRR. So why in India it is 20% plus IRR? The trouble is that the risk weightage that we have on the real estate in India is far different to what it is in a more mature market.
Fair. Let's have the next question going then. All right, in the front, please. Can we have a mic? Sure. Right in the front. Let's have the lady first. Yeah.
My first question is to Anuj. We've been hearing a lot about the REITs paper coming in, and let's assume that it gets implemented as well. But do you think we are prepared infrastructure-wise, like you said, that transparency is actually going backwards? So do you think we'll actually be able to launch funds and attract investors and actually smoothly function with a REITs fund? Are we prepared to handle that? Because we've already seen some papers like IDF. We've already seen that the paper has come and it has been implemented, but practically it has not been, there are not many funds that have been able to launch because of the lack of infrastructure for such funds. So do you think, theoretically apart, are we prepared to launch REITs at this point in time? Do you think so? And I have another question that's to Soumya and Mahesh. Do you think now that AIF regulations have come in and they're still at an evolving phase, especially from a taxation point of view, for example, if you do it in a trust structure, there's a lot of ambiguity that comes in. So whether the taxation happens in the hands of the trustees as a representative assessee, or will the taxation get passed on to the investors, and do they have to bear the tax? So there's a lot of ambiguity there. There's an ambiguity in terms of whether it will be treated as business income or whether it will get as capital gains. So, and nobody can answer that. Nobody can give a straight answer that yes, it will get qualified as one of the two. So how do you handle that? I mean, I'm sure there's a lot of resistance that comes from investors when you go to market a particular fund, because these questions are definitely asked because there's a lot of hassle at the investor's hand. So how do you handle such questions?
All right, let's start off with the REIT part first.
So I am a lot more positive on REIT. And because of two reasons. One, I think genuinely the regulators have applied their mind to this REIT. And I think is previously they were made up with so many policies, not on real estate, but whether it's in FDI in retail or defense or power, and they have seen that there hasn't been much investment that has come in from overseas. This time I can tell you is that they've really gone and seen the more mature market structures, and they've learned from that, and they've really written it up very, very well. And we've discussed with a number of the overseas REITs and discussed those regulations, and they're like, this is fantastic. The only caveat to that is the taxation, which we don't know what Mr. Chidambaram or whoever the new finance minister is going to do. So that's a big if. We think that it is going to be as proactive as the intent with which the REIT has been written. And if it is, I can tell you that is the first very positive point. The second question that you ask is about the infrastructure. Infrastructure for a REIT is very different to an infrastructure for a real estate development, because here you're buying a completed asset. So you're buying an asset which is fully done up, it's fully leased, and you're buying based on the income. So clearly from that perspective, the issues on or the challenges that we've had faced on various approvals or regulatory prospects go away, because this is a full asset. The third is there enough supply? I think today there is enough supply. The earlier session, it was mentioned about 330 million square feet of office stock is there. and perhaps 1/3 of that may be available for a REIT to be able to come up. Some of it will be people like DLF or Blackstone or Embassy or RMZ who are going to do their own REITs. Some of it will be third party where you will be able to buy those assets. So clearly from that perspective, I'm not worried on the infrastructure or from the supply side. The only caveat on the first point is that the taxation needs to be conducive.
So may you not start with the second part?
Specifically on the comment on taxation, I think part of it also has to do with the fact that these are evolving new structures. So whether it's REITs, whether it's AIF, we are going to be in a scenario where you're going to have this little bit of uncertainty on some of these issues, like any new business which has its teething troubles. So I think what we are certainly looking for is where there is clarity from all regulators specifically, because often one of the things that we've experienced is that you've had something come from one regulator, but it's not in sync with what guidelines another regulator has put out, and therefore there's this huge ambiguity and gray area in a couple of areas. There was obviously, in terms of the previous session, a fairly detailed discussion in terms of the taxation, the ambiguity around it, the fact that it's taxed at the fund structure. So I guess these are things which will evolve. We'll probably definitely see it in REITs as well, but we need to be open to the fact that when we are certainly dealing with investors, they genuinely like the concepts. The question is, we're going to work through the other areas which are typically there.
So if I can just, this was a lot more obfuscated 8-10 years ago. Since then, we've returned money several times. Pass-through has happened unchallenged. We've had enough prior art, enough precedents to be able to very clearly now be able to advise our investors of what exactly is going to happen, depending on whether they came from Mauritius or Cyprus or Singapore or whether it's Indian money. So I'm not as concerned as perhaps it sounds, because we have enough. I mean, we've returned money has gone through, taxmen haven't come knocking at the door, it's been approved. We have enough judgments as well as significant advice from, pretty well, reasonably, smart people out here. And even when there's no precedence, we have, exact precedence, we have lots of prior art that gives us advice on where to go to. So I'm actually not so concerned about it. There's still some I's to dot, some T's to cross, and some knots to tie, but that's much, much fewer than it was like 10 years ago.
Sure. There's one more question there.
Yeah, my question is to the panel. See, we were just looking at the alternate investments arena, the entire asset class which is there, post 2012. Now, what is the kind of assets? We are seeing that there is a lot of discussions happening in real estate, because whenever there is an alternate investments means the discussion is in or around the real estate market. That is number one. And number two is, do you see a lot of people, other funds, otherwise which comes through either private equity or through which is coming through this route, how comfortable they are to adopt this particular route? That is